Hey everybody, it's Rhonda German, and I am live as I stated I would be for our live to talk about the types of loans and the credit score needed. So give me just a minute to get Amy onto the live. Just waiting for her to pop up. Hey Nicole. You guys check in as you come in. Hey Monica. Hope you guys are having a great night. I'm Rhonda German. I am a local real estate agent here in Columbus, Georgia, and I currently am brokered with Coldwell Banker, Kennon, Parker, Duncan, and Davis. Hey Christine. I am just waiting for Amy to pop on, you guys. Amy is with Ruoff Mortgage. She is an awesome lender, and she comes very highly recommended from me. Amy is going to take care of you just like she is, or just like you are her own family member. Hey, Amy. All right, I'm about to add you into the video, okay? Have to like accept the request or something. Hey, Amy.
Hello.
All right. All right.
Sorry.
It's okay. So we've got a few people joining in. I'm gonna wait just a few more seconds to see if we get a few more people to jump in. Like I said, tonight we are going to be discussing the different loan types and the type and the credit score that you need for those. We've already talked about the pre-approval. We've talked about why you need a pre-approval. So the next step now is to finding out what type of loan options are available to you guys. Okay.
That sounds good.
All right. So, well, why wait? Because they can always come back and watch this video, right? So,
Okay.
Amy, tell us a little bit about you and your background before we get started.
Okay. So, been doing this for a little while. In 2004, I started doing mortgages and have been doing so ever since. So I've seen the changes in the housing market many times. And the lending products have changed a lot. So that's, yeah.
That's you.
That's about it. Yeah, work hard and watch changes and stay on top of it. And yeah.
All right. Well, like I say, you guys, Amy is the best in the business. She comes highly recommended from me.
Sweet.
But let's go ahead and get started. So, Amy, there are 4 different loan types. What are those different loan types that are available?
Yeah, so I would say commonly in this area, we see a lot of VA. So if you have any military background, then you'll be able to look into a VA loan, and that's 100% financing. My printer's finally printing. That's actually what was holding me up. And it has decided it's ready to print now. Sorry. Anyway, so that is 100% financing. So if you're VA qualified, then we would probably talk about that first. If that's not an option for you, then we would probably talk about FHA because that's a lower down payment option. And it's also a little more credit lenient. So they're a little more forgiving on if you've got some blemishes or some things that you've taken care of. And that is 3.5% down payment on an FHA. And then conventional is going to be another one. So if I have a credit score in the 700 range, we're probably going to talk about conventional. You can do as little as 3% down. You'll get a good interest rate at that point. And then also we can do discounted mortgage insurance if it's your first home. So we can talk, that's kind of getting into it a little bit deep, but that you can do a conventional with a minimum score of 620. You're going to get a better rate going FHA. So we would get more into that, but that would be the third one. And the fourth one I think you're thinking about is USDA. And that's the 100% financing. I like USDA a lot. There are income restrictions, so you can only make a certain amount per household size. And they also, but it is a good product. It really is a good product. They have limitations as to locations. So, and Rhonda will be able to help more with what locations, but that's another 100% financing program that's available.
Okay. So guys, we have 4 different loan types that you guys are able to look at. So starting with VA, since that's the most common one, we are in a military town, so we see a lot of VA. So if you guys have a military background, that's going to be an option available for you, 100% financing. Amy, tell us a little bit more about the VA loan.
Yeah, so VA loan is a great product. If you're eligible for VA, we're probably going to dive into it right away and not talk about many other financing options. I will always go over those with you, but it is the one that does not have monthly mortgage insurance. The other products have monthly mortgage insurance unless you put 20% down. So it's definitely by far the best product available if you have that eligibility for it. And it's also credit forgiving. It walks and talks a lot like the FHA loan product, where the minimum credit score would be about 620 right now. And then also it's forgiving on blemishes. I have heard a lot of feedback lately from not just agents, but borrowers that have reached out to me and told me that they don't think that they qualify for a VA loan because they've been told that they have to work on their job for 2 years. And that is not true. You do not have to be on that specific job for 2 years, but I've heard it multiple times recently, and that's why I feel like it's kind of important to bring it up. You do have to have a 2-year work history, and we need to tie it together, and we can explain any job changes, but it doesn't have to be, and there can even be gaps of employment. We just explain that, the reasons why, but it doesn't have to be with the same employer. But VA is a good loan, and it is also a forgiving loan as well.
Okay. Can we get help from the seller with closing costs with the VA loan?
Yeah. You can, so it's up to you can ask for up to 4% of the sales price. So just as a general figure, if you're buying $100,000 house, you can ask for up to $4,000. And so forth. Typical closing costs on, let's just use like a $250,000. I don't know why that number sticks in my head right now, but on a VA, that's probably about your purchase price point typically. And that runs between $6,000 and $7,000. And I know that's a broad range, but until we see those taxes come in and what the attorney fees are going to be at, and homeowners insurance, then I like to kind of go on the high side of things just so that everybody's pleasantly surprised at the end.
Okay, great. Yeah. And let's see. The next loan type, what the most easiest one from what I hear is the FHA.
Yeah, I like FHA. I am really shocked when I hear people say I don't do many FHAs. I don't really like FHAs. I don't know. It's an interesting thing to me because FHA is a really good product with a low down payment, and you can ask the seller for up to 6% in closing costs. So you have a lot more flexibility, and that's a $100,000 price range to ask for more closing costs. So with that said, when I say a 3.5% down payment, if you're looking at a $100,000 house and I'm saying 3.5% down, that's $3,500 down. So, and down does not mean the day you sign the contract. Down means after everything's settled at the attorney's office and the final figures are in. However, it very rarely is a full 3.5% because of the credits. You'll have, and again, this is a lot of information, but you do have seller credits such as tax proration credits, prepaids that you've paid that will reduce that 3.5%. So you'll likely bring far less than $3,500 to the closing on an FHA for $100,000. Okay. And then you figure if it's a $200,000 price point, then it would be $7,000 down. And again, you're probably going to bring more in the neighborhood of about 5.
Okay. And what kind of credit score are we looking at with FHA?
620. Right now, everything across the board's kind of settled in at that 620 mark. It used to be that we could do no score and 580s, but then during COVID, everybody kind of went up to 660 for a while, and then it just kind of, but we've kind of nestled into that 620 score for now, which usually if I'm talking to someone and we're at that 580 mark, a lot of times we can talk about what's it going to take to, what balances to pay down, what collections to settle, because we're not too far off usually.
Okay. All right, so that's 2 types of loans, VA and FHA. So we also have conventional. Who is the conventional loan for?
Anyone as well. The reason why I would talk to someone about an FHA versus a conventional is a conventional will only allow for 3% in seller paid closing costs. So you'll have your down payment, which can be as low as 3%. It's typically 5%. So you're talking about $5,000 on $100,000, and then you can only ask the seller to pay for $3,000. So you're going to bring a little more to closing on a conventional. And then also, if I have any, credit score below 700, we're going to look at the difference between what's the rate on an FHA and what's the rate on a conventional, because I can guarantee you the rate on a conventional and the payment on a conventional is going to be higher than the one on the FHA. They have risk-based mortgage insurance. So if you're under a 700 credit score, then that mortgage insurance, that monthly mortgage insurance is going to come in higher due to any kind of credit score hits. On FHA, it's a set amount of mortgage insurance per month.
Okay. Great.
Regardless of the credit score.
All right. So, and then we have the USDA, which is also 100% financing, meaning no money down. But credit score is required for that. Give us a little bit more information.
Yeah, 620. Now they're a little bit more, they like reserves. So they're going to like to see that you have maybe 1 to 3 months worth of principal, interest, taxes, and insurance. So 1 to 3 months worth of house payments. They're going to like to see that in your savings account, or in a checking or savings account. Doesn't mean you have to bring it to closing at all. It really just means it likes that sense of, okay, if something happened to them, they could make their house payment, because that's usually a priority for people to pay for their house, and they'll pay that over other things. So they'll it usually likes that about 3 months of reserves, especially on that lower credit score end. It also is very ratio tight. So on the other loan products, I can typically go up to 50% total debt to income ratio. Again, a lot of information and things I can go over with each individual over a call. But USDA is a little more strict. They really don't like to be above a total debt of about 36. Sometimes I see a 42. So that's where it gets into a little different. However, they calculate student loans better. So we're conventional and FHA do that 1% of student loan payments that we have to do of the balance. USDA lets us do 0.5. Okay. So I have a little more flexibility when it comes to someone with student loan debt in USDA. So it just always depends. I look at all of it.
Okay.
Kind of lay it
out. Guys,
there.
while we're going over this information, feel free to go ahead and drop any questions that you have in the comments, so that we'll be prepared for those once we get to the end of the broadcast. But Amy mentioned DTI, or debt to income ratio, and just a lower scale definition of that is basically how much debt you have compared to the income that you're bringing in. So that's one other thing that's used when determining whether you can be pre-approved for a mortgage or not. Sometimes you may have the credit score that you need for one of those types of mortgages, but the amount of debt you have compared to the income that you have coming in may be higher than what is required. So Amy, tell us a little bit about that. I know a lot of people, I've had questions, well, Rhonda, my credit score is there. Why can't I get approved? What other things are we looking at?
Yeah, spot on. That happens a lot. So people get very credit score driven. Super important. We're also talking about credit score a lot, right? We're saying we want a 620. So everybody's really working hard at getting their credit taken care of and getting that score up. But if I have a 620 credit score, but I don't have the income to substantiate the amount of debt you have plus that new mortgage payment, and I exceed that 50% or whatever the qualifying is, because sometimes the qualifying gets more strict because of payment history or collections or things that have happened in the past or in the recent past. So that might go down to maybe the qualifying ratio comes in at 42 or 46. And it goes through an automated underwriting system. It's what all lenders use. It's called AUS, automated underwriting system. So that communicates directly, and it reads the risk levels. So it pulls in the credit report, it pulls in the information that I've entered in the application, it pulls in all of the debt and the income, and that's where we get our baseline pre-approval from. And that's where I initially know what ratios I'm going to be working with.
Okay. So another question I get, I don't want to cut you off, but another question I get sometimes is, okay, my credit score is 580 or maybe in the low 500s. What do I need to start doing to start working to get my credit back up?
Yeah, so that's something so I would ask that question a little differently. It's not just about the score. It is about the score, but you can come to me with a 620 score and have a $9,000 balance on a repossessed vehicle, and we have to get that taken care of, because anything that can affect the integrity of the lien or of the deed on the property, so someone can come in and put a lien on the property after you close, then they're going to require that to be, it can be settled, but they're going to require that collection to be settled. So a good rule of thumb is that medical collections are generally not required to be paid. I highly recommend that you settle them, because they do anchor you down for, I know that everybody says they fall off after 7 years, but I see them transferred too often to other collection agencies and stay on there. You dispute it and then it gets transferred. So I am all about the disputes, and I've seen it work, but then I've seen them come back in a year or two, and then you have to start this process all over again. So I highly recommend trying to settle. I also hear myself when I say it, and know that means that, I don't want to come up with the money to do that, and I can't. Yeah, so I understand that completely. And so then that's when I would say focus on the ones that are non-medical first, and then if you can, start hammering out the medical ones.
Okay.
But yes, that would be something that I have happen a lot. I get that phone call a lot. I've got my credit score up, I'm there, and then I go and I pull credit, and they have had late payments, but somehow they've worked with someone that's helped them with their credit, and that's manipulated the score to get up there. But it doesn't necessarily mean that they qualify for a mortgage, because it's more than just score.
So that's important information to know, you guys. So, because we will have someone coming in to talk about credit tomorrow night, but it's important for you to know that what they are doing is helping you with that score.
Yeah.
They're helping you with the score. It's not always necessarily helping you with,
right.
Like Amy was saying, some of the balances that you may have that will have to be taken care of before you can get a mortgage. You're going to say something, Amy?
Well, that's what you said. But also, if you have someone that they are going to work with and they want to reach out to me and say, hey, here's what I can do to get their score up, but they've got these other items, I have no problem telling them without me pulling credit or without me, running it through the system. I can pretty easily identify which ones would have to be taken care of ahead of time.
Okay. Now, one thing I did recommend to one of the group members is, if you are able to get a copy of your credit report, you can get a free copy of your credit report once a year from freeannualcreditreport.com, and I'll put that in the group. But you can get that, and Amy can take a look at it and, you know, kind of let you know some things you need to hit on.
Yeah, I will. Yeah. I used to be a real stickler, and I am still, on not pulling credit. But now that now that I realize that people are really engaged because of Credit Karma and Experian app, I realize how much more engaged people are with their credit, which is so great. But they have a misconception of what they need to take care of and what they need to do and what they need to focus on. But then I'm like, okay, great, we got it. And then I pull their credit after we've been talking, you know, for 6 months, and they're all excited. And then I pull their credit, and then now they've got 6 more months of work and waiting to do because I didn't see their credit. So yes, either the free annual credit report or even me pulling credit. Again, I know that it's a hard inquiry. They say it's not. I don't believe it. It's an inquiry is an inquiry is an inquiry. So it'll show up as a hard inquiry on your credit report.
Because if you know your score is less than what is needed to be pre-approved, it really wouldn't be a bad thing. It wouldn't hurt them any worse for you to pull it and be able to see what they need to work on. And that's a great way to get a plan of action so that you can know exactly what you want to work on. So if that's something you guys want to do, and you know your credit score may be under 620, which is the requirement for all of those loans really that we talked about tonight, I'll leave Amy's information in the group. Reach out to her so that we can go ahead and set you guys up on a plan of action, because it's not only just the home buyer education portion of the process. You have to actually get there first, and that credit score and, you know, credit history is what's holding a lot of people back. So that's going to be your next step before you can get that pre-approval.
Agreed. Okay. Yeah, I think it's a good idea. And it takes 10 minutes to just pull credit. We don't have to go through the full loan application. We can just do the credit inquiry, and then I can email the pages of the credit report that need to be addressed, and so that you can have those. Even so that if you are still, you know, going to work with a credit repair person, then you can share those with them as well.
That's great. That's great. So we have a couple of questions here before we end the broadcast. But how far in advance should you get your pre-approval?
Yeah, so that depends. I would say if you know that you are you know, ready to go, the credit report that I pull is good for 90 days, and I will not have to re-pull that credit unless you don't close within a 90-day period. And then we'll re-pull credit prior to closing, only if you don't close in that, like I said, in that 90-day period from the initial application. So if you think you're 90 days from purchasing and your credit is there and you know you're ready to go, then any time that you're ready to do so and close within 90 days. We can re-pull credit. If your credit's strong enough and you're not worried about it being pulled a second time within 90 days, then you can, if you want that buyer confidence, you can get pre-approved whenever you feel like you're in that place. If you want to talk with me about it first and see when you know, about your scores and what you're seeing on Experian or on Credit Karma, we can have that conversation. Sooner rather than later is the better time on having that conversation regarding a pre-approval.
And let's touch on that really quick. Credit Karma and these credit apps, how reliable are they?
Well, I really like them so that everybody's keeping their finger on the pulse. So they know, hey, so I don't have that credit card, or that's not my collection, or, oh, I've got a collection. Now let me call them up, get that taken care of, tell them that's not mine, or, oh, it is mine. Now let me take care of it. Will you remove it? Because I never received a phone call or any documentation on it. That's the first thing you should ask, is for them to remove it, especially if you have not received a letter or a phone call from them asking. Usually they'll be very nice about it, depending. But I like them for that reason, that you can watch it. But the scores are not going to match my scores. Very rarely are they spot on. We pull for different reasons. So you're getting a consumer-facing score when you are in those apps. So it's not collateral based. And then when you apply for a mortgage, you're getting a mortgage collateral-based credit inquiry. So that's what it's for. And the same thing, if you left my phone conversation and went to buy a car, they would tell you your credit score is completely different when you got there too, because the collateral is different. Same if you went to Kohl's and applied for a credit card, they'd send you a disclosure and tell you what your credit score was, and it'd be different than mine and different than the car lots. It just depends on why they're issuing you credit. It's called a Vantage score.
Okay, and that's good to know. I know a lot of banks offer the Vantage score.
Well, so we each pull different Vantage scores. So they're all Vantage scores. They're just all different Vantage scores. Does that make sense?
Yes.
So the mortgage one's a certain 7, I don't even know what it is, but they're all different something point something Vantage scores.
Okay. All right. Well,
Right.
this is great information. I hope you guys learned something tonight. Make sure you get with myself or Amy if you have any additional questions. Amy, thank you again for your time.
Thank you for having me.
We will definitely have her back because there are some other topics that I know some group members wanted to touch on, like bankruptcy or, how much am I going to actually have to bring to closing, cash to closing, things like that. So we definitely want to make sure you know everything you need to before you actually pull the trigger to actually buy. All right. But thank you again, Amy. I hope
thank you.
Have a great night. Okay.
Yes, thanks everybody. Bye. All right, take care. All righty, bye-bye.